I'm Alec Hogg from BizNews.com, and with me today is a visitor from the UK. South African he is, Sean Peche, who founded Randmore Funds and has been a regular on BizNews TV. Sean, good to have you here in Cape Town.
Alec, thank you. Lovely to be here at these beautiful studios.
Last time we saw each other was at the BizNews conference in the Drakensberg. Have you been in South Africa all this time, a few weeks?
I haven't actually. I did have to sneak back to the UK for meetings for a week, but we were nominated as one of the top global equity funds by Morningstar, and the awards dinner's tonight. And so that's an important event, and Morningstar, excellent company. And so I wanted to show my support and come out and attend that. So great to use the opportunity to see you too.
And I guess the fact that the world is so connected means that you haven't missed anything with this chaos that's been going on in global markets in the last few weeks.
No, I haven't. Not at all. And, opportunities. So we've always got to look for the opportunities. It's so easy to just get struck by be a deer in the headlights and think, oh my goodness, here we go, European banking crisis Mark II. But we've got to find the opportunities, and that's what we do.
You mentioned European banking crisis. One of the oldest banks in Switzerland, Credit Suisse, has been in trouble for a long time, and it seems to have finally hit the wall. It's been acquired by a competitor, Union Bank of Switzerland, UBS. Is that something that we need to be worried about? Because certainly Mr. Market is in a panic.
Mr. Market is. And I remember the late, great Simon Marais once saying to me when we were discussing banks when I worked at Orbis, he said, Sean, some of the oldest businesses in the world are banks. And they are. And I think Credit Suisse was founded in 1876. But they're only good businesses if they control risk. If they don't control risk, they're not good businesses. And so if you look at the banking failures historically, Northern Rock in the UK, they didn't control risk. They were lending people 125% of the mortgage value on the assumption that you would use the 25% to put in a new bathroom and a new kitchen and therefore add value to the property.
But maybe they just went to the pub.
Exactly.
Or on holiday to Spain.
Correct, Alec. And so I think that is the key thing. There are good banks and they're bad banks. There are good food retailers and they're bad food retailers.
And Credit Suisse was not a good bank.
Well, unfortunately, they stopped controlling risk a little while ago. Certainly not as effectively as they should have done. I mean, UBS is also a Swiss bank. Goldman Sachs manage risk well. They didn't.
It's simultaneously in the United States, we have Silicon Valley Bank that went bust and two others that are in deep trouble. Now, we did speak to Koki Koyman about this a while ago.
Yeah.
And the way he explained it was that they really just didn't have cash. They didn't have liquidity. How does all of that work in that context and in the European one?
Yeah, so that's a good question. And I watched Koki's interview. I thought he did a fantastic job explaining it. I couldn't have explained it any better than how Koki explained it. But what happened essentially is there was a concern over capital. And then as soon as people realized that, they wanted their money back. And liquidity, my brother-in-law used to work for a bank, and he said banks don't go bust because of a lack of capital. They go bust because of a lack of liquidity. And when people want their money back, you've got to be able to provide it. And so what happens is banks will take our deposits and they will invest those deposits and lend it to other people, home loans and that kind of thing. But they should keep some of the cash on the balance sheet as cash in case you want your deposit back. Okay. Now,
because not everybody's going to want their deposit back at the same time, unless there's a panic.
Now, if you look at Europe, and if you look at what's happened certainly since 2010, before the European crisis, and you look today, and we did this exercise, when this all unfolded, we've been doing it for years, but we went and had another look and said, well, have we got our numbers wrong? Are we worried about these European banks? If you look at what percentage of total deposits, and you could also drill down, some banks disclose demand deposits. In other words, demand deposit will be a call account. Total deposit will be a call plus a 32-day.
Well, like if your money's in a check account, would that be a demand deposit?
That'll be a demand deposit.
You can take it out immediately.
You can take it out immediately, okay? Whereas if it's a fixed rate for 30 days or whatever, that's in total deposits. Anyway, in Europe, about 35 to 40%, depending on the bank, of deposits is held in cash. In the US, it's low single digits. Go and look at that. Go and have a look at the, 2, 3, 4, 5% of the major banks they keep of total deposits is kept in cash.
So let's understand that from a layman's perspective. If there is a run on the bank, and the depositors go to the bank and want their money out, and if somebody can't get their money out, well, then everybody's going to try and do so.
Correct.
What you've said in the UK, let's just use 5% as a benchmark.
Yeah.
So you've only got, of the money you've lent out, or the money people have given you.
So 100 of deposits.
100 deposits, there's only 5 in cash.
Correct.
So if people who've got 10 in cash come to you and they want their money out, just 10%,
Yeah.
you actually have to close your doors.
Yeah. So some of that will be in short-term interbank assets because banks lend to each other based on who else needs money at the time. But what I'm saying is that the US banks operate on far lower liquidity levels from what the numbers show me than European banks. Okay.
Why do they do that?
Well, there's a chase for returns. They run, US businesses are run aggressively.
Take up more risk.
It's a very generalized statement, but the return on equity for US banks has historically been higher. And we now know why. Because they run aggressively. Why did they go put the money on long-term deposits to earn 1.6%? Because it's better than naught sitting in cash. Okay. I mean, that was the average yield that Silicon Valley invested at, 1.6%. And you locked up for 10 years. I mean, it's crazy. So European banks have historically had lower returns than US banks, but that's because they're managed more conservatively. And right now, in this environment, you want conservatively managed banks. And so if you have banks that are conservatively managed, and the European banks that we own, most of them, they coped with the European crisis extremely well. Okay, book value barely went down because they're well managed, and they're conservative, and they're not chasing short-term returns to get the share price up to cash in the share options and pay the CEOs lots of money, which is what we've now seeing with Silicon Valley. All these CEOs and CFOs have been cashing in share options. I mean, they didn't have a risk officer for a year, Alec.
But in 2008,
yeah,
we had perhaps a preview of all of this, where bankers made an inordinate amount of money by taking a lot of risk. And then when it went wrong, they were bailed out by the system. And there was a lot of anger amongst the public that this had been allowed to happen. Have the Americans not learned anything?
I mean, I don't know, but it doesn't appear like that. That was sort of mortgage and homeland. Oh, I think there's lots of US banks that could be in trouble. We don't own any US banks in our portfolio. Any. I mean, if you look at Bank of America, if they marked to market their investments, and it's on the front page.
What does that mean?
Well, in other words, so they've taken, because with the Silicon Valley, they took money, put it in long-term bonds. Then interest rates rose, which meant that the value of those long-term bonds fell. But in US accounting, they record that at cost, amortized cost. So they're not recognizing the current value on the balance sheet.
So you can have a really bad egg in your reserves.
Correct. Which you haven't recognized.
When you go and try and collect it, it doesn't exist.
I mean, for Silicon Valley, their equity was $16 billion, but they were sitting on a $15 billion loss on mark-to-market. So if they took that through their accounts, they only had $1 billion of equity and $200 billion of assets. Okay. So that's the problem. Bank of America have got, I think it's $120 billion of mark-to-market losses. I mean, it hammers their book value. All of a sudden, people who think that Bank of America's on one times book, no, it's if they marked to market those debt securities, it's basically twice book value.
If they took the true value of their reserves, is what you're telling us.
Yeah, true value of assets.
Then it would be worth a heck of a lot less.
Correct.
Than what they are telling you.
Yeah.
Because a lot of the assets, a lot of what they've invested the depositors' money in, has gone into assets that aren't worth what they were worth previously. But I guess the point here is, you say in Europe, it's different.
It's different.
And it's different because...
Well, it looks to me like the accounting is more aggressive and more demanding because European banks do not have that same problem. If the percentage of, I think I'm right in saying percentage of BNP's assets in long-term securities recorded at amortized cost is 4%. Silicon Valley, it was 50.
Okay. So, but we did have Credit Suisse. Is that a one-off?
Well, that is more investment banking related. Okay, so that's because they had losses from Greensill and Archegos, which is all linked to the investment banking arm of Credit Suisse, and that they were regulated by the Swiss Central Bank.
But before getting into the detail of it, from what I'm hearing you is that in America it could be a systemic issue, whereas in Europe not so. In Europe, yes, they've had this old bank that's gone bust and has now been taken over.
Yeah.
But in the US, the rot could be a lot deeper. Europe, generally speaking, is good, excepting for this one bad apple. The US, there could be lots of bad apples.
Yeah, and I think the only way out for the US is for the Fed to guarantee depositors at all banks. I mean, otherwise, if you don't do that, well, you might have seen that interview with Janet Yellen and the senator from Oklahoma the other day. It was quite frightening what he was saying. 50%, I think I'm right in saying 50% of lending is done by community banks in the States. And so if people are not happy having their money at, if they're suddenly worried about the Oklahoma, little regional bank. Yeah, so this could be a regional bank crisis in America. It could be. I mean, we've had 3 banks go bust basically in a week. And there'll be no European banks going bust in a week.
And Joe Biden has been talking to Warren Buffett to ask him, how can you help? So clearly, thanks for explaining that. Getting back to the BizNews conference,
yes.
You also were exposed to, you are a South African, but you've been away for more than 2 decades, but exposed to the reality of the South African risk situation. Yes. And a big part of this risk is 2024 election, where some like R.W. Johnson say the EFF will give the ANC the votes that it needs to stay in government.
Yeah.
It'll be the kingmaker.
Yeah.
And if that were to happen, numerous of our experts here are saying it would be a nightmare scenario for the economy and as a consequence for investments. How are you seeing it from being based in London?
Yeah, Alec, I think, I've been removed from the political situation, and BizNews has been a fantastic intensive course on politics. And last year, this August 1, Chris Pappas and Athol Trollip, who I then had the pleasure of meeting. And I left quite encouraged. You might recall I did a tweet or an article, and I said I felt quite encouraged because if there are people like this making such improvements, goodness, there's hope. Okay. And then this conference, I walked in to Gayton McKenzie's speech. I didn't know who he was because I arrived late, unfortunately. I wasn't happy. I listened to Herman Mashaba and I was impressed. I watched Helen Ziller's presentation. I was impressed. I played golf with Herman Mashaba. And I listened to Pete say that all bets are off. Pete Viljoen say all bets are off. And I said,
all bets are off if?
Well, if the ANC, EFF get together and form a coalition. And that's what R.W. Johnson is saying.
What does it mean in investment parlance, all bets are off?
Well, it's a massive, massive catastrophic risk. How do you value that? What is going to happen? People have stuck it out for so long. The problem is if you look at at behavioral psychology in markets and all these things, you get weakness, and then you get a blow off. You get a exhaust move. Okay, markets fall, and eventually people just give up and they go, right, that's it, I'm out. Capitulation. Okay, and if we get that, we're going to have capitulation, and at capitulation, who knows where prices are going to go to? Who knows? But I mean, substantially lower.
Asset prices across the board, your house, your
correct,
shares,
absolutely,
your retirement.
Yeah, and if you think that I'm buying European banks on 6 and 7 times earnings, okay, with no political risk really, in Europe. Well, what are Europe?
Well,
what
is Putin around the corner?
Well, I understand, but that's why they're 5 and 6 times earnings. But I mean, Putin's been neutralized. But what are banks in South Africa going to be worth? What is property going to be worth here? It could be a disaster.
So you came up with some ideas.
Yes. So what I'm saying is, well, from an investment perspective, and I guess there were a couple of things I wanted to do. First, I wanted people to look at it like an investment and say, well, hang on, we've got this risk out here. What insurance can we take to mitigate? If we could take out portfolio insurance, I'm a South African investor. Let's pretend I've got my property here. I've got a small business. I've got my family here. How do I mitigate against the risk of this cataclysmic event? Okay. Well,
excluding immigrating, which a lot of
excluding immigrating, because hopefully the people who want to immigrate are already gone long time ago. Okay, but how do I mitigate? Well, I would buy some portfolio insurance. Okay, how do we buy portfolio insurance for this situation? Well, you invest, and this is what I said, you invest in political parties who are not ANC parties and not EFF, to get them the votes such that the ANC and EFF, even if they did get into bed together, don't have a majority.
So let's understand this. The nightmare scenario is ANC below 50%. Which is now pretty much certain that's going to happen.
Yeah.
The by-elections are telling us they'll be polling around 40% if they're lucky.
Yeah.
And the EFF bit together below 50. Because if they are above 50%, the two of them, they run the country effectively. You get in this country, you get over 50%, you make the rules for the 100%.
Correct.
So that's the cataclysmic scenario for investors, for the economy. And that is something you need to buy insurance against.
Yes.
If I hear you correctly, you're saying buy insurance by helping those non-ANC EFF parties, what we call here the Rainbow Coalition to a large degree, to get more votes.
Yes.
So that they get over 50% rather than the ANC EFF.
Correct, Alec. Absolutely right. And you don't want them just below 50. You want them miles below 50. Okay, because then there's no problem. So that's what we need to do. So then my idea was, and it came after...
We being people who are worried about the economy and jobs in South Africa.
Yeah. And so I played golf with Herman Mashaba, and I felt I had to buy him a beer afterwards because he suffered through my golf shots. But I said to him after, he said, look, we need 300 million rand to get out there and educate the country. This is what one of the most astute business people in South Africa, who fought the odds and was hugely successful, thinks. And I said, but 300 million doesn't sound like a lot. You just need to take 300 million divided by 1 million. You need 1 million South Africans to give 300 rand. Surely that's doable.
To do what? To give it to Action SA?
Well, in this case, Action SA. But then that got me thinking and saying, well, how many concerned South Africans are there? I mean, there's more than 1 million facing this cataclysmic event. There's tens of millions facing this cataclysmic event. So how do we get those parties, not just 300 million, 3 billion? Why not 3 billion? Because we want to get the ANC and EFF well below 50, not just 49. So then I came up with an idea and I said, well, let's not just back one horse, because, for example, there was a poll in November which said 33% of voters said they are not going to vote DA regardless. Well, somebody needs to appeal to that 30%, and maybe it's Action SA, maybe it's IFP, I don't know. So and if the sole target and the sole goal is to get those other votes well below 50, well, then why don't we spread our support? Pretend this is a portfolio manager. Okay, we've now invested in a few funds, and we're going to see who performs well. So we're going to invest a monthly debit order in each fund, and depending on who performs well, we'll give them more money. The fund, the political party who's out there mobilizing people, getting people to register, etc., doing good things in the community, we're going to give them more money. The people who are doing nothing, we're going to take away.
But another problem here is that many South Africans just don't bother to vote, and certainly the Economist Intelligence Unit said that is one of the biggest threats to democracy in South Africa. That's why we're a fragile democracy.
Yeah.
Because we have a very low turnout at the polls.
Yeah.
Is that another area perhaps that in some way could be bolstered so that people understand that their vote does change or can change?
Absolutely, Alec. And people died for this democracy. They actually have a responsibility to vote. And in Australia, you have to vote. And so we have to get out there and mobilize those people and educate them as to this can make a difference. If you don't want to drive on pothole-ridden roads, and if you don't want to have electricity going off all the time, and if you don't want to live in a crime-ridden environment, one thing you can do to help change that is to vote.
But surely that's the approach rather than political parties, because you will always find people disagreeing. As you said, the DA 33% will never vote for them, even though they've shown that they can manage what they are allowed to manage a heck of a lot better than anywhere else.
Absolutely.
But still people won't vote for them for whatever reason. Yeah. Surely the right thing is just get people to vote, and at least they can pick rather than saying vote for this political party or that one.
Yeah, and I would say, my view in political parties is this is not a football club that you nail your colors to the mast and you stick with them through thick and thin. You vote based on each time. When I first got over to the UK, I voted Conservative. Well, then I voted Lib Dem, and I'm probably going to vote Labour next time. You can change allegiance. You don't have to vote for the same party. Vote for the party that you think makes sense and that is doing good stuff.
At that point in time.
But we have to get out there and get that message out, and that takes money. And remember that I think I'm right in saying this, the collective pot that is given to political parties to spread the messages is based on the number of seats in Parliament. So if there's R1 billion in the pot, the ANC's already got 500 million to go out there, and the other parties are at a 500 million disadvantage. And what I'm saying is individuals who are concerned about this need to top up and counter that. And if I were a property developer in South Africa, a big property magnate, and I've met a few of them, with let's say R1 billion of property, let's say I'm a big one, okay? And I've got 800 million of debt. If property falls 20%, I mean, I'm out the game.
Is that possible?
Easily. Who's going to buy property? What are the property prices doing in Johannesburg? You know, you can buy a very different house, 4.5 million in Johannesburg. My understanding is you buy a house with a tennis court. Down here, you buy, 2-bedroom in a little gated community.
Down here being the
who
Western
knows?
Cape, so it's governance.
Yeah. So we need to take a portfolio approach to this, and we need to, if I were a big property investor or whatever, I would spend 10 million rand. Why not? Giving it to other parties, getting out there, getting those votes.
But even if you weren't a big property investor, if you simply had a property,
yes,
if it's going to fall 20, 30, 40% perhaps, then you better make you better take your insurance, and that's what you're telling us to do.
And that's what I'm saying. And you know what, Alec? I said in my little article, I mean, if you add up the value, and forget if you're a property developer, if you add up the value of the top 20 unit trust, that's R1 trillion. Okay, 0.5% is 5 billion. Can you imagine if every concerned South African said, you know what, for 0.5%, I'm going to do this.
Sean,
and if I'm wrong and the money is wasted and not spent wisely, I've still got 99.5%.
Sean Peche is the founder of Randmore Funds. I'm Alec Hogg from BizNews.com.